Hello and welcome back to the Note. We've had another relatively calm day as Thanksgiving approaches here in the US, although there are some interesting reversals on recent trends. Industrial metals have had a bounce, oil has had a bounce, the dollar has ticked back a little. For now, I'd like to talk about a worrying trend, which is that the US stock market, still just about the healthiest out there in the developed world, is showing very worrying signs of getting too narrow. If you take a look at this chart, it compares the S&P 500, which is weighted according to market cap. The bigger stocks have a bigger weighting, with the S&P 500 equal weighted. That's where every constituent has 0.2% of the index. And you can see that over the last year, the equal weighted index is actually down and it's lagging the cap weighted S&P 500. Now that's very rare. In the great rally we've seen since 2009, equal weighted has tended to do much better. That's because small cap stocks generally tend to do better and they get overweighted in the S&P when it's equal weighted. Now, if we take a look at this next chart, which shows you what's happened since the market hit bottom in 2009, you can see that the market is actually very much narrower even than that. The blue line shows you the FANG stocks, Facebook, Amazon, Netflix and Google. And then the Nifty Nine, as named by Ned Davis Research, adds Priceline, eBay, Salesforce, Starbucks and Microsoft. And you can see that those 9 stocks between them have absolutely trounced the main market over that period. There's very clear, very strong leadership. Now, if we take a look at the last year, you can see that while it was the Nifty 9 in the lead for most of this rally, during 2015, it really is about the FANG stocks, particularly Netflix. If we take a look at this, however, on a market cap weighted basis, with this next chart, you'll see that Netflix, once it's made a slightly less impactful part of the FANG stocks, both the FANG and the broader Nifty 9 are roughly equal. But look how huge that outperformance is, some 60% up for the year so far, while the S&P has been utterly flat. Now, that's very good if you happen to have been in those few stocks, but generally over history, when a stock market narrows down like this, most stocks are actually falling and gains are concentrated in a few. That's a very bad sign. This is what we saw with the so-called Nifty 50 stocks at the beginning of the 1970s, before the great bear market of the 1970s. It's also what you saw at the end of the 1990s, an increasing boom for a number of very large tech stocks as we entered the dot-com bubble. This isn't as serious as either of those cases, but it is another rather worrying sign that the S&P 500 is probably ready to roll over and decline for a while.